All right, we'll make a start. Ina iwi, ina mana, ina hoa mahi. Tēnā koutou katoa. E mihi ana ki a koutou, ko tai mai ki te tautoko tēnei kaupapa. Nā mihi nui ki a Professor Atif Mian, te kai kōrero o te rā. Tēnā koe. Ko Ben Gorproja toku ingoa, nau mai, haere mai ki te tai ohanga. Welcome everyone. It's wonderful to see you join us online for today's Treasury Guest Lecture under the theme Fiscal Policy for the Future. And a very warm welcome to our presenter, Professor Atif Mian. My name is Ben Gorproja. I'm manager of the Treasury's Macroeconomic and Fiscal Policy team, and I have the pleasure of chairing today's session. As some of you have attended these lectures previously may be familiar by now, our current theme explores the role of stabilising sustainable and effective fiscal policy. We chose this theme as a focus for our seminars, as resilient and sustainable fiscal policy is essential to maintain and raise the living standards of all New Zealanders. We chose this theme also to align with the focus of the 3 stewardship reports that the Treasury will be publishing over 2025. We will soon publish the final long-term insights briefing on sustainable and resilient fiscal policy over the economic cycle. The lessons from this series of seminars will also inform our next long-term fiscal statement, which will be published later this year, as well as the investment statement. Speakers are providing insights into how fiscal policy can be designed to support government to meet its current and future obligations while adapting to changing circumstances and delivering value to the New Zealand public. Let me now introduce our speaker, Professor Atif Mian. We are thrilled to have with us today. Professor Mian is John H. Laporte Jr., class of 1967 Professor of Economics, Public Policy and Finance at Princeton University. He's also a director of the Julius Rabanowitz Center for Public Policy and Finance at the Woodrow Wilson School. He holds a bachelor's degree in mathematics with computer science and a PhD in economics from MIT. Prior to joining Princeton in 2012, he taught at the University of California, Berkeley, and the University of Chicago Booth School of Business. His critically acclaimed book, House of Debt with Amir Sufi, explains how household debt triggered the Great Recession and its ongoing risks to the global economy. Professor Mian's research, published in leading academic journals, explores the intersection of finance, the macroeconomy, and the implications of rising inequality. Today, Atif will explore the global reliance on debt, considering the implications for economic stability, equity, and policy effectiveness. Drawing on his pioneering research, he will address challenges such as rising debt burdens, persistently low interest rates, and shifts in savings and housing markets, issues that are deeply relevant to New Zealand's high household debt and structural budget deficit. This aligns well with the insights noted in Treasury's long-term insights briefing. Debt ratcheting up in response to crises can undermine resilience, with higher debt burdens raising critical questions about financing future infrastructure to support population growth and mitigate climate shocks. These themes are central to Treasury's work on fiscal sustainability, resilience, and equitable policy, offering valuable insights into securing better outcomes for New Zealanders. I will now invite Atif to deliver his presentation, which will be followed by the discussion. We'll use the Q&A function in Teams, so please post your question there. If you have any technical query, please use the standard chat function. And if you see questions in the chat that you are, or in the Q&A function that you're particularly keen to hear answered, please do react to them and upvote them. We'll run this somewhat democratically as well. So over to you, Atif, and welcome again.
Thank you, Ben, and thank you all for joining, and also special thanks to the Treasury in New Zealand for inviting me. It's a pleasure to speak with all of you online. I was fortunate to visit in person a few years ago, and I fondly remember my visit to the beautiful country that you have. I'm going to talk about debt. And as the title suggests, I'm going to try and tell you a narrative or a story of why it appears that the world is addicted to debt. I'll explain a bit more what exactly I mean by that. But more importantly, why that is a problem for the economy going forward. especially now from a fiscal perspective. But in my view, the story of the debt challenge that we face today is a bit more complicated and nuanced than perhaps what we see out in the popular press. It's not as simple as saying the governments have been irresponsible and they just need to act responsibly. The key thing I want to argue today is that the reason for our debt challenges today, including the fiscal challenges that we face around the world, has its roots that are much deeper and structural in nature. And that's the sort of the narrative or the story that I want to go through. Also, just so let you know that everything that I'm going to talk about today is largely based on a series of papers that I've been working on over the last few years in work with Ludwig Straub at Harvard and Amir Sufi at Chicago. So it's a sort of this combined synthesis. This view comes from that synthesis of 3 papers that you can look up online if you so wish. One is Indebted Demand, published in the QJE. The second one is Saving Glut of the Rich. That's an empirical paper. And the third one is a theory of fiscal, a Goldilocks theory of fiscal deficits. And so I'm going to, again, weave together the ideas from these 3 papers in talking about the question today. Let me start with this quote from Mariner Eccles, who was the chair of the US Federal Reserve during the 30s and 40s. He says in one of his important testimony to the Senate Finance Committee, it is utterly impossible for the rich to save as much as they have been trying to save and save anything that is worth saving. In many ways, this is the punchline, if you wish, of the structural issues that I referenced. I think it's an extremely important point, a point that is forgotten at times when we talk about these important issues. And one way I would frame this is to say that the economy, take the global economy as an example, it acts like an ecosystem, just like any other physical or natural ecosystem, where things have to be in balance. So if you think of Econ 101, we talk about supply equaling demand. There is this natural force that craves balance in nature. And we see that the reason I referred to the natural or the physical systems, that's true not just for the economy, but it's a natural thing that nature craves, which is balance. But that balance is not guaranteed when we talk about the economic system. And so when the economic system is run in a way that it generates persistent imbalances in ways that I'm going to explain, that is when you get into this core problem that the global economy had during the 20s and 30s that Mariner is talking about, that he is referring to. And we are in the same boat today. In fact, I would argue that that problem today has become actually a lot more difficult. But it's a problem that is fundamentally created by structural imbalances in the economy. And that's sort of the key thing I want to explain today, okay? So that's sort of where we are heading. So now let me get to the core of the topic, which is addiction to debt. So what do I mean by that? Since the US is obviously the most dominant economy in the world, I'm going to fix ideas, I'm just going to talk about the US. It's also a country that I have researched the most, so I feel most confident. However, I should say that I also feel reasonably confident saying that the issues that I'm going to talk about using the US as perhaps the most important example, I think that story, that narrative holds globally as well. But I'm just using US to fix ideas, as I said. So take the US and let's look at total credit to GDP or total debt to GDP, 2 sides of the same coin. This is summing household debt, private non-financial corporate debt, and government debt, the 3 main types of debt that we see around the world. What you see is that it was sort of coming out of World War II, total debt to GDP is sort of flat until you hit the 80s. And from 80s onwards till today, there has been this upward continual rise where total debt to GDP almost doubles as a share of the economy, as a share of GDP. To say the same thing differently, for every dollar of income that the global economy is producing, it now holds twice as much debt. And the question is why? Okay, so this is what I'm calling our addiction to debt. We haven't now notice something that I'm going to come back to. One of these dotted lines that you see after 2000 is referencing the Great Recession, something that a lot of my earlier work was based on understanding the causes of the Great Recession. But let me just highlight, when you look at this total debt picture, and I told you there was this huge financial debt-driven crisis, it's hardly noticeable. In fact, it's not noticeable at all in this graph. Even though debt caused, in many ways, the 2008 global financial crisis, you don't see it in this picture. Total debt continued to rise, okay? That's why I'm saying it's an addiction that we are unable to get out of. And it's a deeper problem than just the 2008 crisis even reflected. And so again, that's a point I want to explain as well as we go along. So keep this picture in mind. I'm going to come back to this picture in a few slides as I try to explain what's behind this picture. Okay, so now let's think about debt a little bit more now conceptually. What is debt? The first important thing I always tell my students is to understand, and it's a very important concept, very simple, but I think it takes us quite far in understanding these things, is that net debt is always zero. There is no such thing as net debt. For every borrower, there is a lender. So when we talk about debt in the usual language, the usual parlance, is what we are referring to as gross debt, right? And so equivalently, I can ask the question, if the economy is borrowing more and more, that equivalently can also be the same point can also be made as saying, why are people lending more and more? Because as I said, net debt is always zero. Now, if you go back to your econ or finance 101 class, when we talk about debt, which is when we talk about finance or financial markets, we always say there is someone who's saving. They're adding to their balance sheet by holding a stock of assets, and they're lending it to someone else who's borrowing that, issuing a liability, if you will. And typically, we tell the story that it's some entrepreneur borrowing it and then doing something positive with that, hopefully, which is what we call investment. So they produce an output into the future. And so there is a very close connection in Finance 101 between rising debt or debt in general and investment. Like that's the excuse we have for debt, that it's financing investment. But the second very important point, and it's something that sort of led me to study this more and more from a long run perspective, is that when you look at the investment to GDP ratio, it's not gone up at all. And it's been flat. In fact, over this time when debt to GDP has been rising, investment to GDP has actually trended downwards. So then the question is, what is this debt financing? And the key thing that comes out of empirical analysis is, and it's sort of an obvious point actually when you look at the aggregates, that first accumulation, because there's no such thing as net debt, the accumulation of debt means that someone is running persistent deficits. Moreover, that someone is not the entrepreneurial class, because investment to GDP has not gone up. And so it leads to the only logical conclusion that this rise in debt has been financing persistent consumption expenditure deficits. Okay, it's a super important point in my view, because that fact, and it's a very big fact, creates a very deep problem, which is, so now I come to the next point. We have all, those who are fond of understanding fiscal issues know this for sure. We talk about the interest rate R and the growth rate of the economy G. We mostly talk about that from a fiscal dimension, but I'll come back to that later on. But there is a more general point that we need to understand. when people borrow in general, they borrow at some interest rate R. So that's the capital R that you're seeing on the slide. What they earn on average is the growth rate of the economy. That's the growth of their income, if you will, on average, by construction, by definition. But the interest rate at which the private household sector typically borrows, or the private sector in general, is actually greater than G, is greater than the growth rate of their average growth rate of their income. Just take that as a fact for now, that R is greater than G for private borrowing. If you take that as a fact, and you also take the second fact that I told you earlier, which is that most of this debt has been going into financing consumption expenditures, you can see that we have an accounting problem, very fun, basic accounting problem, which is if you're borrowing more and more for the same dollar of income, and you're paying on that borrowing an interest rate, and it's persistent borrowing, right? You're not paying it down, but you're paying an interest rate on that borrowing at a rate R that is greater than your average growth of income. We have a problem. It's unsustainable. This whole thing will collapse. This economy will actually collapse. Now that has not happened actually. So this is where this logic of indebted demand comes in. And the reason for that is that unsustainability is handled through the economy. Remember, nature craves balance. So in an attempt to bring some balance back into the system, nature tries to push interest rates down more and more. So I'm going to now explain that in a few slides next. Okay. And so that creates a problem, and that's something I'm going to focus on. When the interest rate at which you're borrowing is greater than the growth rate of your income, but you borrow more and more, this addiction to debt is not sustainable in that way. That's the key point I want to explain as I go forward. But as we understand these issues, a fundamental question that I want to now start with is, okay, before we understand all of that, why are we addicted to debt? Where does this push for more and more debt come from? So let's try to understand that initial sort of primitive force that is causing, if you will, in a structural sense, more and more debt. I want to move towards that. But before I do that, let me give you the second important empirical fact. The first one was this rising debt to GDP, and the second one is falling interest rates. The 10-year real rate, the Cleveland Fed, the only consistent series available is from 1982 onwards. That's why this chart starts from there. But you can see this unmistakable downward trend in long-term interest rates. All of you are well aware of that. More recently, they have gone back up. I'll come to that towards the end of my talk. That's where the fiscal situation is unsustainable. But I want to carefully walk through the story before we get to the end of it to understand why interest rates have risen more recently and how to think about that. So let's focus for now on this big picture, rising debt and falling interest rates, to try to understand where that is coming from. Okay. So this is the most important fact to understand the fundamental primitive force that is pushing debt up and up over time. And that is the saving rates across the income or wealth distribution. The two are highly correlated. Is not constant. To say it in technical language, preferences, consumption saving preferences, when you look at them empirically, they appear to be very non-homothetic. Saving rate out of income, especially out of permanent income, are much higher at the top end, at the very top end. So and they're higher in some of this non-linear sense. That's why it's really about the top 1%. You can see this is coming from our paper, Saving Glut of the Rich. We can measure these savings in different ways using tax records, but also using survey data, and both give exactly the same picture, which is, and again, there's a lot of other empirical work showing the same results. The bottom half of the country essentially is hand to mouth, so they have zero savings. Then savings slowly rises, and it really is much higher at the very top end. And if I were to split top 1% even further, you'll see the saving rate continues to rise. And it's sort of very obvious, when you get to the level of income like Bill Gates, there's only so much that a human can consume. And so it's almost like functionally impossible for a human to spend as much money for consumption. And so what they do, regardless of whatever the underlying reason would be, when inequality is very high and it rises over a period of decades, that's going to create this push of financial savings into the system. And that money has to go somewhere, right? So that's sort of the primitive that, and we know inequality starts to rise exactly when debt starts to rise. And that's the first important point I want to make, that there is a reason why these two variables are so closely correlated in the time series. That exactly when we see this global rise in inequality, you see this global rise in debt as well. So let me show you the same picture in a couple of different ways to further explain this core idea. That is the saving at the very top end of the distribution. That's an important player in the rise of debt that I'm talking about. And it's in this fundamental sense that the economy is facing a balancing problem. So what you're seeing on this chart, I've divided two time periods. 1963 to 1982 is the orange line, and the blue is 1983 to 2019, which is the most recent data from public tax records that is available in the US. And I'm estimating saving rates across the wealth distribution. The top 1% is the most important one, actually, and that's what that circle at the very top represents. And if you start with the orange line first, obviously saving rates have always been sloping upwards. I've already mentioned that. But the second newer point I want to add in this slide is that the same pattern holds in the more recent time period. But notice that the saving rate at the top 1% has risen even more. So the blue dot at the end is above the orange dot. But the saving rate everywhere else, but especially the middle class, so this other dot is the average saving rate, that has actually gone down in the second half of this sample. So post 1980s, the average saving rate has gone down while the saving rate at the top has gone up. The reason for that is this is where debt comes in. And this is where, in particular, debt that is financing consumption expenditures comes in. The only reason people at the very top end could have saved more, as they have done, is if someone else is willing to absorb their surpluses. And there were two possibilities in terms of who could have absorbed their surpluses. The first one, as I've mentioned earlier, is that could have been absorbed by entrepreneurs for investment purposes, but that has not happened. When that did not happen, the only remaining possibility is that the rest of the household sector absorbs these surpluses. But the only way they can absorb these surpluses is by running a larger deficit themselves. That's exactly what has happened over the post-80s period, which again is the blue line, where we see the saving rate of the rest of the population go down as they borrow more and more. And this explains the initial rise in total debt to GDP that you see in the US. In fact, this is the global story by and large. Now we know there is the global savings glut, that China and other countries have been pushing savings into the US as well. So that only adds to this problem. But at the global level, because I really want to talk about the world, there is no, we are not borrowing or lending to Mars. So at the global level, the global saving glut actually adds up to zero, of course. And the key thing I want to emphasize is that it's really a distributional story. We should not think of that as a global saving glut story, but it's really a distributional story at heart. And so sometimes these top 1%, you can replace them as the Chinese government accumulating a lot of surpluses. And you can think of Chinese government as the top 1%, if you wish. It's isomorphic conceptually. So that's a sort of a side point to say I'm not excluding those facts in this conversation. All right, so now let me show you the same picture in one other way, which I think brings home this point more explicitly. Now what I'm doing is I'm showing you the saving from the top 1% versus the bottom 99% in the US as a share of national income, which is the same thing as GDP, over time. And I've benchmarked the two series to 0 as of 1983. Okay, so 0 means that's the average level that these two ratios had. And you can see that the relative saving coming from the top 1% and the bottom 99% was roughly constant or stable until 1980s. And then something starts to shift very dramatically. And this is, again, the previous slide. The two are obviously coming from the same data. So it's reflecting exactly the same forces that I talked about, which is that the saving coming from the bottom 99% really takes a beating. And this is a flow, remember. So think of this as deficits that the bottom 99% are running every year. And again, the scale on the y-axis is as a share of GDP. So these are very large. The gap between the orange and the blue line is very large. And this is entirely a distinct. You will not see this when you look at national accounts. So when you look at the national saving number for the US, you will not, it will mask these trends, because the average is not, the average is kind of in between the two and it's not changing much. But what that is masking is this huge divergence distributionally within the US. And this is what we refer to as the saving glut of the rich. That is this rising inequality coupled with the fact of non-homothetic preferences, that the very rich save at a very high rate. It creates this issue that the savings have to be absorbed somewhere, and you can see exactly who is absorbing them, which is this bottom 99%. Okay. So that's the empirical fact. Now let me pivot to the indebted demand idea, conceptual idea. Let's now put these basic facts of the global macroeconomy. These are some of the, in my view, the most important fact thinking about when we try to make sense of the global economy from a long run perspective. So we need a model to understand the implications of this. So now let me try and give you the basic intuition for that through this indebted demand framework. And I've already mentioned to you this rise of this inequality and the saving glut. I've already said, just take it as given for now that the supply side is very inelastic. I'll come back at the end. We can speculate why investment has not risen, but it hasn't. That's an empirical fact. Just let's take it as given that investment is kind of constant as a share of GDP. In that world, as the rich try to save more and more, we have a problem, because it cannot go into investment. It can only go into financing consumption deficits. And we have a problem because private borrowing R is greater than G. It's greater than the income growth, the average income growth of the middle class or upper middle class that is borrowing. And so we have a problem. Let me explain why that problem arises. And the basic point, so now I'm going to explain just through one graphical analysis the indebted demand notion. So let's plot on the y-axis the interest rate. This is the natural rate of interest. So this is R star, if you will, because I want to think about long run equilibrium. So if we solve for long run equilibrium in this financial market where the rich are getting richer, what happens? We need a saving supply curve, first of all. And the only departure from the neoclassical Ramsey model, if you wish, I'm doing here is that interest rate note. Remember, for those of you who know the Ramsey model, the saving supply schedule, which is the line I'm drawing here, in the standard model is just a flat horizontal line. Why? Because the equilibrium interest rate equals to rho, the time value of money, which is in the preferences. But when preferences are homothetic, that rho is a constant. But when we live in a world where the rich save at a much higher rate, that's the non-homothetic preferences, the one natural implication of that is that the saving supply schedule slopes downwards. And the intuition for that is that if you, I should have mentioned, by the way, one thing, which is what's the x-axis is the level of debt. What level of debt this economy is holding. My apologies, I should have mentioned that in the beginning. So in this RD space, when we plot supply schedule, it's downward sloping. And the idea for that is more debt means the rich are accumulating more assets. for that to be an equilibrium, we need to dissuade them from saving as much. And that's why the interest rate must fall on the equilibrium indifference curve. So that's the only thing that is new here, that you have a downward sloping saving supply curve. The saving demand curve is always downward sloping neoclassical models, and it's the same here as well. So that intuition is very straightforward. The higher the interest rate, the lower is credit demand. The lower the interest rate, the higher is credit demand. So that's just the traditional long-run credit demand schedule. All right, so the intersection of the 2 points is the new equilibrium, is the natural equilibrium. So let's say we are starting with an economy that is at point A. Think of that as the economy in the pre-1980s period. Now, the interesting thing is, I want to do a thought experiment here. What happens when you raise inequality? You make the rich even richer in this economy. What happens? The key thing that happens is that the supply curve shifts inwards. And the reason for that is that they already were, the top 1% were wanting to save a lot. Now they have even more to save. So for the same level of equilibrium debt, interest rate will have to be even lower for you to maintain the same equilibrium. That's sort of this intuition for why the supply curve shifts inwards and to the left when there is a rise in inequality. So the dotted red line reflects the post-1980s new equilibrium, and inequality rises appreciably. And what that does is we move from the first pre-80s equilibrium point A to a new equilibrium point B. And so notice that this simple theory explains the big trends that we see in the data, which is rising debt and falling interest rate. Okay. Now, this is just an equilibrium model. So just the debt rises, interest rate falls. Otherwise, this economy remains in the same output employment equilibrium. So you can say, well, fine, prices change, but no fundamental shift. And that's true. But you get into a problem if this issue of rising inequality persists, because there is something that is well known in the macro literature called the zero lower bound or effective lower bound, that interest rates it helps to lower interest rates. What is happening in English, in words, what is happening is the only way you can make people borrow more and more debt and make it sustainable is for the interest rate to fall. Because remember, otherwise R is greater than G, it's unsustainable. They cannot keep borrowing more and service that debt at the same time. The only way that can be a credible long-run equilibrium, which is point B, is for the R star to fall, which is exactly what all central banks in the world have faced, and they have been forced to accommodate lower and lower R stars. Okay, but as long as there is an effective lower bound, you cannot keep doing that. You run into an eventual problem, and I'll get to that in a minute. This green line, by the way, represents transition dynamics, which I'll skip in the interest of time. Let me just make one other comment, which is also important over this time period. I did one thought experiment in this model, which took us from point A to B. Let me do a second natural experiment, which is also empirically relevant, because that's the other big shift that happens during the same period. Not just rising inequality, but rising financialization as well. What do I mean by that? Maybe it's the information age. We know more and more about borrowers, which allows lenders to lend them more and more. And so there has been this shift in the credit demand schedule as well, the blue line. So imagine that shifts outwards to the right. Borrowing capacity of the private sector rises. Ironically, at some level, that is bad news for this economy. Because when you do this when you add that second experiment, it actually takes you to a bad place. You go from point B to point C. Because when they can borrow more, it doubles down on the indebted demand force. Interest rate now has to be even lower than what a pure inequality shock would have delivered. And so the rising financialization actually pushes interest rates even lower on top of, so you have both these forces, more supply of saving and more demand for credit. They both actually work in the same direction. This again is a consequence of non-homothetic preferences. And now you can see we have a problem because you're dropping below the effective lower bound. And one way to think of this, when did we cross point B to point C? Roughly that's the 2008 crisis. when private credit can no longer be extended because you have hit effective lower bound. And so now you have a problem because you're in the well-known liquidity trap, well-known recession, except this recession is much worse than the standard liquidity trap because this is a permanent recession. Remember, the graph is long-run equilibrium. This is R star I'm plotting. So if you're at point C, you're stuck forever in this liquidity trap. So this is a permanent recession, if you will. Something needs to give for us to get out of this point C. So this is where, let me now pivot to the sort of the last chapter, if you will, of my talk. This is what connects the fiscal situation to this fundamental point of our addiction to debt that I mentioned, which, remember, is itself being driven by these structural imbalances that I've been emphasizing. Okay. So what's the fiscal connection? Well, one way to get out of that, remember, this entire problem started from the fact that the private borrowing rate R is bigger than the average growth rate of the economy. What happens if we can find a borrower, a big borrower in the economy who does not suffer that problem, who can borrow at R less than G? And we all know there's only one player in modern economies who can do that, and that's the government. They can use their fiscal balance sheet to get out of this problem. Let me go back a slide. So if you're at point C and I tell you this is the nature of the problem, can you solve it? The only solution you have on the table is fiscal side comes in and starts borrowing at point C to generate more demand. But their demand will be sustainable because they have this special privilege that their interest rate is less than the growth rate of the economy. So this is where we wrote that last paper of these 3-paper series, the Goldilocks paper. Because while the solution sounds simple, the government borrows and spends, and you can get out of this recession, this permanent recession. That's true, you can. But, so here's the last twist, if you will. It brings in this Goldilocks dilemma. And the Goldilocks dilemma is the following. The government can get you out of this recession, but it must, or it better, calibrate the fiscal action exactly right. So this is the too hot versus too cold problem. The porridge cannot be too cold because you need enough of a deficit, but it can also not be too hot, because if it's too hot, that additional fiscal debt will become unsustainable. And the reason for that is that it's the fiscal deficit that is raising interest rate, and it initially helps because it raises interest rates above lower bound, and that's a good thing. You want interest rates to be above effective lower bound or zero lower bound. So sufficient fiscal action can do that. But then they better not raise it too much. Let me try to explain what problem it creates. But before I do that, let me, in the interest of time, maybe I'll just use words to explain the intuition. But I want to show you this last piece of empirical evidence, which is really sort of key, in my view, to convince, at least it convinced me, that this is the core of the problem. So I'm taking you back to the initial graph, same graph you saw in the beginning, right? Total credit. This is the addiction to debt figure, if you will. What I'm going to do next is I'm going to split this total debt into 2 subcomponents. The private sector borrowing, which is household plus corporations, which is the blue line, and the public sovereign borrowing, which is the red line. Again, the blue and the red add up to the total, which is the gray. So this is just decomposition. The first basic point I want to make is look at the first period, 1980 till 2008, the Great Recession. Pretty much all or most of the rise in debt is driven by a rise in private debt to GDP, not government debt to GDP. Okay, it's a very important point, actually. Next, let's start from the Great Recession and do the same decomposition. When you look at the economy post the Great Recession, most of the rise in debt, it completely flips. Private debt to GDP is now flat. This is the consequence of the Great Recession. You maxed out how much the private sector could borrow. And so now the R less than G borrower, which is the government, steps in. And they are the ones driving the rise in debt because we remain addicted to debt. If the fundamentals are the same, which is to say that by and large, the surpluses continue to be run, these financial surpluses, someone has to borrow at the other end to translate those financial surpluses into real demand. Otherwise, we are going to have a big recession. Now, the problem with fiscal borrowing as a solution is, so this is coming from the Goldilocks paper. This blue line is drawing the stable points where, so y-axis is primary deficit of the government and x-axis is debt to GDP of governments. And the blue locus represents stable points where debt to GDP, if you can run, if you're at the top of this hill, so that is the way to interpret this is that, oops, I moved one. You can run this level of primary deficit to GDP forever and maintain a constant debt to GDP at the same time. The reason you can do that is because the government earns the convenience yield. That's the R less than G intuition. However, if it does too much of fiscal borrowing, deficit is higher, then R starts to rise beyond G and your debt becomes unsustainable. That's sort of this intuition. Okay. Now, the thing about this is that the shape of this debt deficit itself depends on the primitives of the economy. So, for example, if there's a rise in inequality like we had, you actually can and need to run a larger deficit. But if inequality shifts, you actually need to bring deficits down. The broader point is the shape of this locus curve can be shifting up or down. And that is the Goldilocks problem. You have to constantly calibrate fiscal deficits. And we all know how efficient governments and politics is. I think it's an impossible problem in my view, which creates the dangers that we are in today. So let me end by giving you this last picture that worries me a lot where we are today. I'm showing you this primary deficit to GDP, 10-year moving average for the US to focus on the long run frequency over time. And first look at this is post-World War period until the Great Recession. The basic point I want you to take away is that the US, this is cyclical, but largely the US has run a perfectly balanced primary account. The average is 0. First the blue line till the 80s, and then from 80s to 2008. Even when this is period, debt is already rising, remember, but fiscal position has been largely in balance. But notice what has happened since then. The orange line, dotted line here is the average primary deficit since 2008. It's north of 4 percentage points of GDP, something we have never seen before, and is at a level, this is the calibration we show in the Goldilocks paper, so I'll skip the details, but it's actually unsustainable. And the reason it's unsustainable is that we are now in the region of fiscal dominance. This is CBO projection, but I think it's reasons not to believe this projection right now, given the politics and so on. Not just the politics, I should add, given the war drums and so on. I mean, I think it's just we are just in a very difficult fiscal situation going forward. I'd love to talk about that in the question and answer session. This is the historical debt deficit diagram for the US. So the same locus that I was drawing before, this is the empirical version of that. And this is where we are at the right top end. Again, in the Goldilocks paper, we calibrate the sustainable locus, which is kind of like here. If you can see my mouse, that's what it looks like. So we are way above that and to the right of it, which is the unsustainable region. So, and this is the US, the country with supposedly like the biggest borrowing capacity fiscally. The US is in big trouble in my view. But it's not just the US. This is a global issue, and the same picture is there for a number of other European and other big economies as well. The fiscal challenge is very real, but underlying that fiscal challenge is this imbalanced economy. So in many ways, the 2008 crisis never went away because those imbalances never went away. The only thing we did at the global level is we shifted to public debt binging from private debt binging. So, and again, there is this big question, open question, why can we not invest that excess savings? I think it's a very important question, but we can't. For whatever reason, that has not happened. And so in that world, we are addicted to debt, but that's not sustainable. And that's the dilemma that the fundamental issue that we face today. The long-lasting solution is to deal with that structural fault line that I mentioned. But that's where politics comes in. It's a very difficult problem, but I think a very, very important one to solve going forward. I'm out of time, I believe, so let me stop here. I had to go through very quickly through a bunch of things. I apologize for that, but I'll be happy to explain further and answer any questions that you may have. Thank you very much.
Wonderful. Thank you very much for that presentation, Atif. If I may take the chair's prerogative and ask the first question. I guess one thing here is New Zealand's a small open economy, and that means that we're a price taker on our interest rate, and our interest rates are heavily influenced by overseas conditions. Thinking about the slide that in the last bullet point on the slide that's currently up, the challenge we have is that the structural solutions are largely beyond our control, with the exception of changing our openness. So how would you think about this problem and the solutions to it if you were a policymaker in New Zealand?
That's a great question. And a number of countries, like I was recently in Singapore, another small open economy, shares some of the attributes of New Zealand, that it's a country very well run at the macro level, fiscally and things like that, but faces some of these issues. Let me go back to, I think one way to think, I don't think the answer to that is to become less open in some sense. I don't think that's the solution. I mean, I think countries like New Zealand have a lot to gain from trade and so on and so forth. So I would not argue for that to address this problem. But I would emphasize that the distributional angle of this issue. I think that is how I would approach it domestically for New Zealand. Let me try to explain what I mean by that. One implication of these falling into, so I actually want to go back here. So one implication of this indebted demand force, the falling interest rate force that I emphasized earlier, is that if you don't respond through other means, for example, in particular, the taxation tool, what it does is it raises the valuation of existing long duration assets. And the biggest long duration asset is land and housing. And so asset valuations rise. And this rise in asset valuations is purely driven by falling interest rates. And I think clearly New Zealand has experienced a lot of that, making housing unaffordable. The way you try to make it affordable, ironically, is you then, through the banking system, you say, okay, maybe you can borrow more. Interest rate is lower, you can borrow more. That's partly that financialization shock that I was talking about it. I think that accommodation of this global, so if I would push back, coming back to your question, Ben, I would not push back on this through restricting openness. I would push back on this by addressing this feedback mechanism. And the way you do that, so how do you reduce the effect of interest rate on long duration assets? Well, the answer to that is to raise the user cost of land. To say it differently, from a taxation perspective, I think land needs to be taxed based on market value of land. And so that mitigates the impact of falling long-term rates, because the rise in tax acts as if interest rates have risen when you're doing the valuation of land and housing. And that is the right balancing act. You can, and you're taking, and you can use that revenue to lower income taxes actually. So my advice is to move the taxation system in that direction, but do it in a revenue neutral way, because the broader macro point is not raising revenue, but to make housing more affordable from a valuation perspective, and make people who are productive in the income sense, make it more affordable for them. So they will be, yes, the user cost is higher, but people with the higher income should be able to live in the most appealing neighborhoods as opposed to people who have the richest parents, so to speak. And so it's more coming back to your, I mean, I agree that a country like New Zealand cannot do much with the global forces, but it's more the taxation tool in particular needs to be used in a much more unorthodox manner to respond to these shocks than has been done in the past, because that has led to its own issues like unaffordable housing that I mentioned earlier.
Great, thank you. We've got lots of great questions flowing through now, and I'll just start picking some of them out of the chat. Again, just encourage people to upvote those ones that you're most interested in hearing. But one from Mario, which sort of follows on from that question that we just asked, was thinking across countries, don't we observe similar outcomes on debt and investment dynamics, even where inequality has not risen to the same extent? So, for example, we can think about Japan. But if inequality is the critical source, then wouldn't we see a clearer cross-country pattern?
That's a great question. So let me try and address this. Two important points there. The first one is just from a purely empirical perspective, and you can go look at the world I think called income data or income inequality database by Piketty and Size and Zuckman. When you put all of the cross-country data together, the global trend is very clear. There has been a rise in fact, again, because what really matters is the non-homotheticity of saving rates, right? So it's really the saving rate rises non-linearly at the top. So you really want to focus on top 1%, number one. And the first basic empirical fact is that share of income going to top 1% has risen in every major economy. So there is even Japan. So there is no country in which income inequality has gone down. That's fact number one. Fact number two, the reason, remember, this is a global the interest rate is a global interest rate. And so what matters for the global economy is the global net surplus. And countries can shift some of their surplus abroad, but that's not going to change the basic message of that's why I mentioned during my talk, I mentioned there is no Mars that you can ship your surpluses to. And so it's a purely distributional point. And that's why top 1% rising everywhere matters, because there's no way to escape that fact, essentially. That's number one. Now, let me talk about a related comment that can be thought of, which is, well, the rise of China suggests that there has been this fall in inequality from this global household perspective, and that's true. But remember, the fall in inequality in the Gini sense does not matter, because it's really saving at the very top end that matters. So if everybody is growing, but it's making the top 1% of the global economy have a larger and larger share of again, it's the share and the top 1% that matters, then you're back into this main problem. So you can have the Gini coefficient falling, but as long as the top 1% share is rising, it doesn't solve the problem, okay? That's why China growing does not solve the problem. It actually adds to the problem, given that China itself has been saving more and more, right? And that's the last point I'll make to this comment, that for ease of exposition, I only focus on the top 1%. But I briefly alluded to during my talk as well that it does not have to be literally the top 1%. If you add in this economy a government player, a big player, who starts to run large sovereign wealth funds and starts to save on a massive scale, like China did, or the oil-producing countries did, it translates into exactly the same phenomena, the same problem. And so that has also, that force has also fed into exactly the same dynamic at a conceptual level.
Interesting. Very interesting. I've got a couple more questions which I'll bundle up for you now. One, and this is sort of looking at both where we might get to and what it means for monetary policy. So first is, if debt traps are so pernicious, why haven't we seen more dramatic economic collapse? i.e., what's preventing the full deflationary spiral the model predicts? And linked to that, a question from Ash. You set out your view that current US fiscal policy is unsustainable and may be entering a regime of fiscal dominance. Can you spell out more what this would mean for monetary policy and the credibility of the central bank in anchoring price stability? How would you see the transition between the current regime and one of fiscal dominance taking place?
Yeah, so first, the earlier question, why do we, if I understood that correctly, that question is basically, why do we not see more deflation, more of, is that, did I get that right, the first question?
Yeah, correct.
Yeah, the basic answer for that is that we did not, because of the fiscal action, right? That's kind of the point. That 2008, so if you go back to this graph that I showed, we just re-emphasize this one, right? So look at this red line. It's not just for the US. You see this rise in public debt in a number of advanced economies. My point is that that's an equilibrium phenomena. In the counterfactual world, where the US did not have this extremely aggressive fiscal policy, we would have seen exactly what the model and your comments suggest, which is the US would have had. And so it's good that they avoided kind of this bad outcome for at least over the short term, and the other countries did as well. And so that's how we avoided deflation, number one. Number two, relatedly, it's sort of interesting to look at the cross-country kind of phenomena of how different countries dealt with it. Let me just talk about China a bit here. It's a bit of a segue, but I think it's kind of useful. China is a country that relied on other countries, in particular the US, to absorb its surpluses. And that allowed it not to suffer deflation, because other countries were buying their goods and borrowing their credit. And so it allowed China to avoid deflation. But when the 2008 crisis hits, that's a huge deflationary shock to China. Okay? And let's think of what China does to accommodate that deflationary shock. They do it in two different important ways. The first one is they start borrowing domestically like crazy, very deliberately through government action. So you see domestic debt to GDP that starts. In fact, we have never seen the rise of domestic debt at a pace that we have seen in China. It's unprecedented. The US subprime binge and other countries, Scandinavian, New Zealand, add them all together, they all pale in comparison to the pace at which the Chinese have added domestic debt. They've had to avoid deflation, to generate debt-driven demand. It is that push that has eventually led them to the recent real estate crisis, which is their version of 2008 crisis, with Chinese characteristics, because there's no Lehman Brothers to collapse, because everything is state backed. So you're not going to see that collapse, but you're seeing what your comment is predicting, which is you're seeing deflationary forces in China today because they're facing those problems. So it just shows up, these phenomena shows up in different ways, and obviously are contingent on government action and policy action. That's important to keep in mind. So now let me come to the other question, which Ben, you'll have to remind me, I've forgotten the second question now.
Yeah, so it was, if US fiscal policy is unsustainable and we're expecting to enter a regime of fiscal dominance, what would that mean for monetary policy, the credibility of anchoring price stability, And how do you see the transition between the current regime and one of fiscal dominance taking place?
Yeah. The short answer is, I mean, I've already said that I see that as the biggest danger. We have entered a period of possible fiscal dominance. I'm trying to use my words carefully here. So let me try to explain why I say that. A few months ago, the Fed raised an unexpectedly interest rate more than expected by 50 basis points. The market median expectation was 25. The 10-year rate responded not in the wrong direction. It went up. And this is something we have not seen in the recent past. And there are other signs like that to suggest that the markets are pricing in more and more the likelihood that interest rate is not going to be driven in the long run by monetary authorities, but by what is happening on the fiscal side. And they will be forced to raise rates back up or will not be able to keep rates down if they want to maintain inflation target. And if they don't, for political pressure, which you're also seeing in the US very clearly, a very worrying sign, if political pressures continue, then the markets are saying, well, then the inflation anchor is off the table. So either way, I mean, it doesn't, that's the point, as when you lose monetary dominance, when the fiscal pressure is, either way, it doesn't really matter. The market does not want to be, it does not want to be fooled twice. It was fooled once under the pandemic, which allowed, and you see this dip in public debt to GDP because of that unexpected inflationary shock. So you were able to get away with it, you being the governments, were able to get away with it once. But I imagine the bond market vigilantes to be much more careful now. And I think they are. That's my reading of the financial markets, the global financial markets, that they don't want to be fooled twice. And they are much more careful about, and that's why it's much harder to bring interest rates down on mortgages and things like that, because I think the market is, for understandable reason, is like, look at these fiscal deficits, where are they going to? Now, we all know that, bombs are flying around the world in different parts of the world. That's extremely worrying. Because I was just looking this up. Look at I was looking at US deficit, primary deficit to GDP over the last 150 years, to include World War I, World War II, the Korean War, and so on and so forth. And the spikes in military spending during wars is just, we are talking about 2% to GDP, 4% to GDP. I mean, you are in the 10 to 40% of GDP range, just to put this in perspective. When the world enters major conflict environment of a military nature, the level of expenditures that you need, and you're forced into those expenditures, right? Because it's like, and I'm not, so this is why I say, I think coming back to what will central banks do? Well, the central banks, they will not have a choice. I don't think, now the thing is, in that world is not a normal world. You do not have standard operating procedures in that world. Historically, what we have learned from historical experience is that you enter a world of financial repression in those circumstances. So that's my other main worry, if you will, that when you enter this period of fiscal dominance, sustainability questions, a very natural place. I think this is one issue, by the way, that we don't understand as well, we meaning on the academic side. I think we need to have a much better understanding of that, how financial repression works and what are its costs and so on. Financial repression is very costly because and my understanding of financial repression is it's very costly in the sense that it crowds out private investment and growth. So the real cost of financial repression is long-run growth, basically. But it does allow you to add fiscal space in the short run. And governments, when push comes to shove, they go for that trade-off. They add more fiscal space in the short run through financial repression of various sorts at the cost of long-run growth. And of course, that means at the cost of long-run welfare. So that's my main worry. And I just worry more and more with given where the politics and the news cycle is heading. I worry more and more every day that we are heading in that direction of fiscal dominance, financial depression, and with lower growth for the global economy.
Thank you. So I guess there's been a couple of comments in the chat to the effect of thinking about trends, interest rate trends going in the other direction. So one around global aging and people moving from saving to dissaving as global populations age. Similarly, from Grant Spencer, is the downtrend in interest rates now reversing due to deep globalization, growing fiscal deficits, slowing China, and a retiring population? I think there's a theory put forward by Charles Goodhart and Pradhan around the potential reversal in some of these trends that we've seen over a while. Any views on that, or whether these are sufficient to counteract some of the trend or some of the forces that you're talking about?
Yeah. Look, I think all of those are very genuine questions in the following sense. Equilibrium interest rate, or R star, is determined in equilibrium by a number of forces pushing and pulling in different directions. That's sort of, and that's exactly right. So the demographic forces are, in fact, even the demographic forces can move things very differently in the short run versus the long run, because there is this steady state population, and as the population ages, it has a different dynamic on the net saving profile. But I think whatever the net balance of those forces might be, like think of inequality versus demographics, like as two forces in opposite directions, if you will. Wherever those two forces might end up interacting in the long run, one thing is very clear to me, which is, at some level, the problem is much simpler these days, which is when you have already entered a world of where the fiscal is dominating, that is the first thing to look at. Like whatever else might be happening to demographics, those are slow-moving variables anyways, a slower-moving variables, I should say, anyways. My sense right now is that the immediate most worrying thing from a long-run interest rate perspective is the fiscal situation. That's sort of my take on that question, if you will, right now. I do agree that given the other forces and all of that, I think my bet would be that if we were in a normal world, like fiscally and politically, my bet would still be that we would go back to this long-run pressures of downward pressures on the interest rate. But I think the big unknown is, and that's the thing, I think that's the sort of the marginal issue. The marginal issue in my mind is the fiscal one. Because deficits are very high. I mean, at basic level, in the long run, like the US, how much revenue the US can generate has not really fluctuated much. It's like roughly 20% of GDP, the federal revenue. And interest rates, tax rates have gone up and down, but that's so there is some sort of a Laffer curve in the background, and this is sort of how much revenue the US is going to generate. So then you just do some simple math. Look at the federal debt to GDP ratio, where the interest rates are today, and what that means for other space for other kinds of expenditures. And a lot of the social expenditures are kind of baked in. So you very quickly get to this position that unless you either raise revenue through some new sources or cut back spending, neither of which is happening, the US is in a unsustainable track, and that is sort of I think the more powerful driver of interest rates at this point. And so the other forces are more in the background, in my view.
Thank you. And then I guess maybe move on a little bit to maybe what does this mean in terms of policy responses in New Zealand. So we've got a question from Max Rashbrook, which is, if economic inequality is at the heart of the story, what role do you see for Pickettyan wealth taxes aimed at the wealthiest 1% or 0.1%, etc.? Or another way of asking a similar question around what does the policy response look like, from Mario again. Are we doomed to a 20-year financial crisis where we write off debt at lower income levels? We can think of this as a random periodic jubilee year where debt is forgiven at the lower end. Yeah, policy responses, where to begin?
Yeah, so let me start with the debt jubilee point. The debt, I think that's what, again, we've had this in the right. So what was it? The famous farm debts that were a big problem, and then Congress had to act to write down the value of those that were initially tied to the gold and all of that. The one good news in the modern economy is that, that's the advantage of having a fiat currency, that that sort of debts naturally erode as well. So you may not need a debt jubilee. The fundamental problem with debt jubilee, however, is at a conceptual level is that those are just temporary fixes. You reaccumulate it back up. It does relieve pressure in the short run, but you reaccumulate it back up. So it's not a structural solution, although it helps on the margin. Which brings us to the other question, the first one, the wealth tax question. It is exactly right, and we talk about this in the Indebted Demand paper as well, that under this framework, under this model, I try not to be ideological because I don't want to be ideological, because it's a social science, so you want to what's the assumption, what's the reality, and what are the scientific set of implications. So if you go by the logic of sort of the indebted demand model, if it's these structural surpluses which are creating the problem in ways that I've tried to describe through the lens of, again, that indebted demand framework, a very natural policy prescription that comes out is exactly the wealth tax policy, and particularly a wealth tax that applies at the very top end. However, an important point I want to add to it is that the push for wealth tax is not political, ethical, or ideological. It's not even to raise revenue. I think that's a very important point in my mind. The argument in favor of wealth tax is to rebalance the economy, to rebalance the system. And so the optimal policy response to the lens of the model is the following. And it's the best response. And like this, you just need that policy and everything, you solve everything actually, and forever, right? So in that sense, a very good policy. It is a wealth tax at the very top end, but it's a tax that you put in a revenue non-neutral way. So all of the revenue that you generate, in fact, the more you do this, the less of wealth tax you need to raise actually, in sort of this a bit of an subtle point. You lower income taxes for the middle and upper middle class. So you do it in a net revenue sense. So you just rebalance the economy. That pushes natural rate of interest up, takes you out of the debt trap, rebalances the economy. There is no longer a need. This is the key thing. As a rule of thumb, if you see an economy persistently relying on debt to finance consumption expenditures, we have a problem. And so you're doing this calibration of raising wealth tax, lowering payroll income tax. What you're really trying to do is you're not trying to raise revenue. You're trying to rebalance the economy. And what I mean by that is empirically, you can see if you're successful or not by looking at whether the economy is using debt to finance persistent consumption expenditure deficits. And that's what you're trying to do. That's the unsustainable thing. Because the income of that class of individuals is not going to grow faster than the rate at which they are borrowing. That's the core problem.
Very good. Thank you for that one. I think just extending on that a little bit, and again, coming back to maybe the question I asked at the outset, which is, New Zealand's challenge as a small open economy. In a world where the hyper-rich, hyper-mobile, and capital is easily moved around, is there a solution to this without global economic collaboration? And we've seen, digital services taxes, corporate income taxes flounder in terms of being able to set those collectively and avoiding races to the bottom. Is that something? Is that a problem that we'd need to overcome in order for wealth taxes as a solution to be workable and viable?
Yes, I mean, again, I think that's very clear. There has been, if you look at the OECD, what they were able to do, quite remarkable, actually, in my view. That they were able to come together to pass the global minimum corporate tax rate. I thought it was a huge sort of political achievement in that sense, political in the sense of global countries coming together. Now, obviously, I understand that. I mean, the problem is sort of the US, if you if you will, where I'm sitting right now. It's not possible to have a global agreement of a nature that is important and credible without the US being part of it. And so yes, so that is an important. I mean, the same thing is true for climate as well, among other things. And I mean, I think for me personally, who cares a lot about humanity in general and us as a globe rather than just as any particular country at a time, I think that that's the usual problem of human governance, that you need to be able to come together to solve these public good problems, if you wish. So we can't run away from that fundamental issue of governance. But I do hope that, let me say it differently. I think it's again, this is where the OECD example is useful. I do think there is clearly a possibility that we can move in that direction, number one. And number two, for the large countries, they can just internalize a lot of it. So the US does not have to worry about it as much. They could just unilaterally do it.
Okay. Thank you. Yes, as I was saying to you before we started, New Zealand's exposure to international shocks and trends obviously makes things very difficult for us, and the United States is obviously a very critical player. I think we've got time for a couple more questions, hopefully, and I'll just bring up one now, which is from Benjamin. On wealth taxes, if sophisticated investors are rationally choosing household debt over productive investment, isn't this a coordination problem rather than a savings problem? The smart money prefers mortgage securities to funding startups. Wouldn't addressing the distortions, to the extent that you think this results from distortions, be more efficient than destroying the savings entirely?
I think this is a very important question, and a question I've thought a lot about, and I don't have a good answer to this question. So let me try to explain a bit more. I mean, I think the question is exactly right, first of all, that if you can do all of this, we should do it. Like, I'm all for it. The problem is that the financial sector, we can't force the financial sector to make real investments, right? Which is why I kept saying throughout my talk as well, let's just take it as given that investments are not at the aggregate level. Investment is not, that knob is not going to move much. Now, I have done some work. So I've done some work with my colleague Ernest Liu, and we have a couple of papers on that, where we argue that it is possible that, for example, that as interest rates become much lower and lower, rather than those interest rates becoming expansionary by leading to investments, they can become contractionary. And the reason for that is that lower interest rates, you can show conceptually or theoretically that lower interest rates favor, from the financial market perspective, it favors industry leaders more than industry followers. And so the Googles and the Apples of the world become even more dominant because they can borrow much more easily, and they can expand their power, so to speak, and they can threaten. So they can, for example, buy out any competition much more easily in a very low interest rate environment. And so we highlight that because of forces of that nature, very low interest rates, which are driven by rising savings, can perversely lower investment rather than raise it, because it makes the industry and corporate environment more monopolistic. That's the idea. That's the intuition. But that's just one idea, of course. I don't mean to say that that is the world we live in all of the time. But what I'm trying to say is that we have seen, and we do continue to see, another way of saying it is this puzzle that, if you think of Tobin's Q, price to book value, market to book value, it's at the highest level internationally and globally. And so sorry, you have my 6-year-old coming in. I apologize for that. He just lost a tooth, so he had to come in and show me his lost tooth. So I apologize for that. But coming back to bigger issues, it is a puzzle why despite valuations being very high, we are not seeing corporations make more investment. And again, you can just go to Apple and see that they are sitting on huge piles of cash, but they are not investing more. All of that is to come back to say, that's why I said I don't know the answer to this question. It's a very important question. I agree. What we do know is that that's not happening. Now, there is this abundance book and literature coming in the US. I'm myself very interested in that. And I do feel that there is a lot to be said about things like regulation, supply side issues in general that are restricting investment in places where investment needs to be made, number one. I think that should be a focus of attention to partly solve this problem in a good way. I agree with that logic. I think that is important. I would also say that it is also very clear in my mind that investment cannot just be driven by the private sector, because there are very important questions of coordination. I think that was implicit in this comment or question as well. I think there are very important issues of coordination and commitment that some of the investment has to be coordinated through the public sector. Like think of infrastructure, think of chargers, electric chargers, and things like that. And I think if you look at the spend, this is the other dimension, by the way, where I'm really worried on the fiscal side. It's not just that the fiscal side looks unsustainable. The composition of spending also does not look very good. And this is really very much related to this investment question. For example, if you were to just take the US, the fraction of government spending in the US that was going for R&D and investment has fallen to very low levels. It used to be 2-3 times more than where it is today. And it's by and large true in many of the Western developed economies. And that is a problem. So governments have become more of like just spending like for consumption or transfer reason rather than investment reasons. So I think government investment needs to go up and needs to be done intelligently and so on. Countries like China, of course, are an exception, but I think there are other countries that have really lagged behind and have been unable to absorb savings that way. So that's a big problem. I'm just a last comment on that. I mean, I'm in favor of the concept of dynamic scoring when it comes to doing fiscal arithmetic. Partly because I think if we just force ourselves through dynamic scoring, it will encourage and incentivize the public sector to push expenditures in the investment bucket rather than in the consumption expenditure bucket.
Interesting. Yes, that's a great link that I hadn't drawn at all. I think we've got time for one last question very quickly. We've got a few coming through which are all on the same theme, which is around what should we do, what should small open economies do, and what should central banks do? So maybe just open the floor to you, really. You're speaking to a lot of policymakers here, or a lot of policy advisors here. Any advice on what do you think is the most material things that we could do? If you had a hit list of 3 or 4 things that you'd think an economy could pick up, what would you go for?
Yeah. I think, first of all, you keep doing what you have been doing right, which is to say an open economy that encourages rule of law, that encourages macro risk management. New Zealand obviously, is the leader in central bank thinking and so all of that. So I think all of those are successes. So first of all, I think it's important to not, to not lose sight of that there's a lot of good that has been done by these successful small open economies like New Zealand. And I think, for example, having a flexible exchange rate is a very good thing. You want to use that for all the usual reasons. So there's no reason to move away from any of that. There's also no reason in my mind to close down in that sense, as I've said earlier as well. So I think, first of all, the first rule of policy is don't mess things up any further, right? Before you start taking any new action. On things that I would suggest, I've already mentioned one, which was, I think there is the system of taxation in my mind is very important. And it's very obvious. It's like, you want to tax dead capital and you want to not tax productive effort and investment. And I think this is important for modern economies, which is you don't want to tax labor income too much. I think labor taxes are just too high in advanced economies, including the US. I think labor taxes need to come down, and we need to raise taxes on unproductive capital like land. I've already given that example, but there are others. I think that's a very important and interesting area of domestic fiscal policy that needs to be opened up. I know it is politically difficult to do, but I think this is, I'm an economist, and I think it's the direction in which we need to have that conversation. By the way, if you were to put that to a vote, it will win out, as wealth tax always does. So it's more of a political power issue as opposed to, the median voter issue. But I think we do need to think in that direction. And again, I'm not trying to raise taxes. I want to lower taxes one that way and raise them in another way. It's about rebalancing the economy and having the right incentive structure. So tax policy is extremely important in my mind for incentives in a system. And I think we have it wrong currently, given all the issues that I talked about. So that's the very important area that I would focus on for a smaller economy like New Zealand. The second point I'll mention is two more points I want to make. The second point I would make is, this is a tricky one. I think I don't want, because I've talked about the problems with countries like the US that, fiscally they are in a problem and so on. I think there are countries like Singapore, like New Zealand and so on that have managed their fiscal side very well. And I think that's very good. So I don't want them to lose that ability. The tricky thing, however, is that there are occasions, and Singapore is in that situation right now. I'm not sure about New Zealand, so I won't speak, but it's possible. That's why I mentioned this. That sometimes you want to relieve pressure on your currency appreciating when you're running very, very low sovereign debt and so on. And you get into this problem of everyone is like Dutch disease kind of issues, right? That everyone wants to park their money in. How do you react to that? I think in those times, there are two things, sub-points I want to make. But the first one is, I think if you think about that conceptually, that everything I said about taxing non-productive capital will actually help you on that margin as well. So that's the other reason you want to do it, is because you don't want money to come in and lead to a problem. And so that's why those sort of taxing that is helpful. But if it's too much, which sometimes it is for small, open, very successful economies, you do want to, at that time, use that money by relaxing your fiscal budget constraint and doing a bit more of fiscal deficit spending. And so I think understanding that for very successful small, open economies like Singapore, Switzerland, and as I said, New Zealand could very well be in that position sometime as well, is useful to understand from a policymaker's perspective. So that's the last point I would say is a number of open economies are now facing that immigration pressure. I think it's a very important political, economic question going forward. And that has to be managed properly, but it should not be managed in a way that you cut down on the positive effect of immigration for long run growth. So I think that has to be mediated very carefully. I understand both sides of the economic imperative and the political. I think I want to recognize both. And so I think it's very important that you don't lean too far in one direction. I think that's very important. I think for a country like New Zealand, immigration is a very important driver of long run growth, given fertility issues, given the productivity benefits that the right kind of immigration brings. I think it's important so it's important for New Zealand to protect that element of its openness as well.
Wonderful. Thank you for that. That's an excellent very thought-provoking answer at the end of a very excellent and thought-provoking talk. So we've run out of time, so we'll bring today's session to a close. But I just want to thank you very much again, Atif, for taking the time to share your insights and your experience with us today. The chat was sort of flooded with comments thanking you for the thought-provoking lecture. So yeah, we very much appreciate you taking the time to talk to us. Very quickly, a plug for our next seminar, which is taking place on the 31st of July, which we will hear from Belinda Story, who is the Managing Director at Climate Sigma, that provides scenario analysis and asset valuation on the physical risks from climate change. And she's a Senior Research Fellow at Victoria University of Wellington. The details for that event will be on the Treasury website shortly. But for now, let me close our seminar today and farewell you all with a karakia. Piki te kaha, piki te ora, piki te wairoa, huie, tae kie. Kia ora koutou. Thank you all for attending. Again, Atif, thank you very much for joining us. Mā te wā. Bye-bye.
Thank you. All the best. Thank you.